Maria Rosati, CEO of Eminence Communications. Today, I'm joined by Tom Dierdorff, Managing Director and Group Head of Financial Services for Regions Bank, and Dietrich Moor, Managing Director and Group Head of Asset and Wealth Management Coverage for Regions Bank. We're going to be discussing succession and ownership transition for older advisors. So, Dietrich, let's start with you. So advisors talk to their clients all the time about retirement, but what should they be thinking about when retiring and transitioning their business?
Thanks, Maria. It's a terrific question, and it's unfortunately one that advisors really don't think about as much as they should. According to Cerulli, the average financial advisor is age 51, and 38% of financial advisors are planning to retire in 10 years. And this demographic reality represents 66% of a total addressable market for RIA acquisitions of $2.4 trillion over the next 5 to 10 years. So there are a lot of good reasons for financial advisors to adopt a succession plan. And those include the overall value of the business that's enhanced through this virtuous cycle of succession planning and really migrating a wealth management practice to a wealth management business. Secondly, the risk mitigation that takes place from being overly dependent on key team members. There's a compliance benefit with a lot of regulators really recommending succession planning as a key part of a business continuity plan. There are employee retention benefits because it provides a path for valued employees to grow. And finally, client retention. You've got clients that want assurance of continued quality of care going forward. And so the fact of the matter is that you've got really strong drivers for succession planning. And unfortunately, the reality is that TD Ameritrade found that 2/3 of firms reported having a succession plan in place, and only 37% felt that it was an adequate plan. And the simple reason for that is that establishing a succession plan is difficult. It entails multiple steps and certainly requires an advisor to think about timetable, hiring a team of advisors, including bankers, attorneys, recruiters, CPAs, to refine and implement the plan. It requires identifying a successor for the advisor. And this involves not just looking at the traits and capabilities that you want that are sort of obvious, but also less intuitive ones. So ones that involve things like the ability and the appetite to fund significant debt, to acquire equity, the patience to financially support the business in periods of reinvestment. So I think when you look at some of those components of a plan, you've also got the deal structure that you have to consider as well. How you're going to basically sell the ownership to a successor, what sort of financing mechanisms you're going to have in place, what sort of valuation methodology you're going to use, and what sort of protective provisions might be in place if the succession plan doesn't work out. So we're definitely at a position where it makes a lot of sense, but we don't see a lot of planning really taking place at the advisor level today.
Okay. And so, Tom, what are your thoughts on succession and ownership transition for advisors?
Well, look, I agree, Maria, with a lot of Dietrich's points. I think at the end of the day, wealth management, financial advisory services, it's a human capital business. And unlike a lot of their clients who might be business executives or small business owners, where there is very clearly a going concern of a business after the sale, So much of the value of a financial advisory business, a wealth management business, is tied up in the relationships of the founder, owner, the key producers of the business. And I think it's just good hygiene for everyone to take a step back and think about the legacy that they are going to create with their business. I mean, are they have they been thoughtful and intentional over several years about creating sustainable value for their clients in terms of perpetuating those relationships and those services, but also maximizing the value that they've created in the very good work that they've done on behalf of their clients over the years.
Okay, and so, with that said, there's also two ways to sell a business, internally or externally. So, how does an advisor know which is best for them to do? And let's start with Dietrich. What are your thoughts on that?
Yeah, thanks, Maria. It's a terrific question, and look, I think at the end of the day, value is enhanced by optionality. So the more your business is worth to an internal investor, the more it's probably going to be worth to an external investor, and so you really come back to succession planning and really considering both paths early in the process, and the ultimate decision really being driven by a number of factors, including the size of the business, the availability of a capable successor. I think when you look at an internal sale, you've got you have the reality that across all firm sizes, grooming a successor from within the firm is really the leading choice of many advisors. And look, it makes sense, right? This allows for a more seamless potential transition of the business and therefore greater equity value in the business to be harvested by the advisor. With that said, there are several challenges. You've got challenges potentially in finding good successors. You have a demographic challenge with a lot of baby boomer financial advisors looking at a relatively depleted cohort of Gen X financial advisors that have lived through the tech bubble bursting in 2000 and the crisis of 2008, and you have sort of a millennial financial advisor cohort that potentially have very different sensibilities, and so you've got this. You've got bigger firms that are potentially going to cost a lot more for a successor advisor to buy into as well. And the reality is that smaller firms have a lesser tendency to favor internal succession because you also have not only a smaller pool of internal candidates to draw from, but you've got other strategic resources that an external party can really bring to bear. Fields like product, technology, marketing, and so I think that when you look at things like bringing in an external advisor, you really want to be very cognizant of things like their investment philosophy, some of those services that could be cross-sold to your existing clients, the quality and scale of the technology platform, the quality of the brand, because clearly migrating clients to an external buyer is going to be a very important part of what the deal looks like. Certainly, the approach to servicing clients is going to be very important. Spectrum Group had a survey recently where they noticed a big gap between the client services that are expected and those that are received by many wealth managers, and those include things like trust services, estate planning, tax planning, non-liquid asset management, life insurance. So it really depends. But again, I think coming back to succession planning, having that optionality is very important as you start the process, and where you end up is going to really be determined by some of the other factors that I covered.
Okay, so you covered that pretty thoroughly, and you had mentioned that Cerulli said the average age of an advisor is in his 50s. So let's talk about when an advisor should start the planning process. And I'm going to turn that over to Tom to get your thoughts on, given that most of them are in their 50s, what's the ideal age to start?
Well, it probably starts the day you put your own shingle out. Really, I think everyone thinks that they are going to be at it for some indefinite period in terms of building a book of business, building client relationships, a portfolio, and a good durable business. But the fact of the matter is, really, years before you actually believe you might be monetizing or partially exiting your business for retirement or other reasons, you need to be thinking about taking appropriate steps to build an internal market. You asked earlier about internal versus external sale. Candidly, it's really hard to pull off an external sale if you haven't done the right things to build an internal market for equity in your business, right? If your team doesn't buy in, conceptually or practically in your business, it's going to be hard to tell that story effectively when you are looking for liquidity. So I think to Dietrich's points earlier too, doing the right things in terms of how you set up your business, how you create accountability and effective operations, overlap, approaching clients from a team perspective, making it about the firm and not just about any one individual or key producer is going to be really important. And then again, reiterating some of Dietrich's points, putting the right mechanisms in place, how you put the right economic incentives in place, profit sharing, phantom stock, or outright equity participation for your key people in the business. Putting those things in place early enough to start momentum for the ultimate monetization of the value that you've created in the business.
So, you touched on liquidity, and so has Dietrich. So let's go back to Dietrich. How is the best way to maximize liquidity in succession?
Yeah, Maria, I think, look, the ultimate goal for an investor, whether internal or external, is to avoid their investment being dependent on one person. In this case, the advisor. And as Tom was just discussing, the more advisors can build a business that's not dependent on them personally, the more liquidity they'll be able to harvest from a transaction, and the less need there will be for deal mechanisms like equity, earnouts, non-competes. We recently advised on a transaction where the founders owned the majority of the equity, but culturally did not like to use employment agreements in the organization. They learned when they were having conversations with an external investor that an employment agreement would be required of the founders, and they ended up agreeing to that. But some of that could have been mitigated had they been able to sell more of their interest in the business over a period of time, and being in a position where, again, the business was perceived to be less dependent on them. I think the reality is, when you look at the wealth management landscape, Maria, you've got a seller's market out there, and have had one for the last 20 odd years. But in our experience, buyers really tend to dominate when it comes to negotiations, because they come to the table more prepared. And we recently were advising a buyer where they ended up significantly reducing their price when one of the key producers at the target tried to hold up the deal at the last minute. And so I think that you look at the drivers of valuation in a wealth management business. You look at the recurring nature of the revenue. You look at how how concentrated the client base is, what the retention statistics look like. You look at the quality of the technology and the infrastructure. You look at the geographic footprint. You look at the leadership team, the bench strength, the growth, and the scalability of the business. But again, it really all comes down to the succession plan that you've been able to develop at the beginning, and some of the strategic measures you've taken to build value in the business, and not necessarily had to make tactical adjustments really at the 11th hour, whether it's having people be required to sign employment agreements or take a certain earn-out percentage of their consideration. That's really going to help you drive valuation and liquidity.
Since the onset of COVID, we've seen the wealth management space adopt technology and become more digital. And so I want to ask you, Tom, how do you see technology playing a role in advisors' transition and succession?
Well, I think like many industries, technology is becoming more important over time, and I think there have been shifts, obviously, in wealth management, right? And I think some of this is generational. I think understanding how your current clients, but frankly, potentially their heirs, might use or want to use technology in sort of the delivery of your service. Obviously, the real value in wealth management is in the advice, right? The incremental value created from having a client-centered plan. But understanding how clients want to use technology is really important, or their kids, frankly. It's do I want to do this over the phone? Do I want to do it in person, or do I want to be able to get online after dinner and just check my account values, or pull some tax forms or what have you? So I think there's the client-facing aspect of it. I think there is the client relationship management side of it. How do you manage data and analytics around your clients and their portfolios to be most productive, most efficient, and deliver the highest caliber service that you can? But I think something that, frankly, all of us in financial services have come to realize more and more, over the last 15 to 20 years. But compliance costs are also taking a bigger bite out of our operations, and I think that's the same in the wealth management space as well. So, you have to have good technology. There has to be at least an effective baseline of technology that serves your clients and your regulators effectively. Your team needs to see that. They need to be on board with the technology plan of your firm. And I think, again, as you think about selling a business over time, demonstrating adaptability and utility with technology is going to be important to make sure that you can present the right set of financial information, client information, or portfolio, broader client portfolio information, to a potential buyer or investor in your business.
Great. So let's get to the most important question. How do you communicate your transition to your clients? And I'm going to start with you, Dietrich, and then we're going to go to Tom.
Yeah, look, I think, again, it really should be a process that extends back to the beginning. And over a period of years, an advisor implementing a succession plan is really going to want to seek to identify client needs and introduce members of the team with greater knowledge in those topics. And these conversations will not only encompass other members of the advisor's team, but also other members of the client's household, specifically the spouse and children. And this process of institutionalizing a client relationship is really, in my mind, a critical step in in really being successful in making sure that clients feel that they're not surprised when a retirement takes place, and that they feel that it's being done for all the right reasons, and most importantly keeps them first in mind. So look, as a banker, it's a critical component of my job to as a coverage officer for wealth managers, often in the middle market, and we define that as starting at around roughly $25 million of revenue, and where I'm speaking with CEOs and CFOs, Regions is as my employer is very focused on the quality and scope of our institutional relationships with corporate clients, and therefore we seek to actively engage with clients around topics including transaction advisory, capital markets, loan syndications, risk management, treasury, and I have product specialists at Regions which will lead many of those discussions and will engage with corporate development officers, treasurers, financial controllers at our clients. And similarly, I think financial advisors should be seeking to build a network of relationships between the firm and the client. Of course, the chosen successor needs to be a critical part of those discussions as retirement approaches.
Okay, and so I'm going to turn it over to Tom for your thoughts.
Sure, Maria. Dietrich and I had talked earlier, and it was interesting. We had seen some statistics that talked about the expectation on the part of advisors, with the intergenerational, transfer of wealth, far more often than not, they believe that they are going to hold on to these assets. And in fact, the converse is usually the reality. More often than not, families fire the advisor when the wealth is transferred down to the next generation or to the spouse. So communicating, having a plan and a relationship, not just with your primary client or clients, but with the family. And also, as Dietrich said, institutionalizing the relationship with your own firm, having other disciplines within your firm or in your network that can help institutionalize and cement that relationship. Switching costs in wealth management are high, but there is a point at which, if you haven't done the right things, it makes it a pretty easy decision, for families, widows, widowers to take that relationship elsewhere if you haven't done the right things to take care of it. So I agree with you. Communicating early, talking about and practicing what you preach, having a plan, communicating your plan with your clients about your own firm, making sure that they understand that, their interests come first. You have no business without them and their success. And that you're committed to preserving that and continue to perpetuate that long after you've left the scene. It's going to be really important.
Okay, so that's all the time we have for today. Tom and Dietrich, thank you for joining me. I look forward to hearing more in 2021.
Thank you, Maria.
Thank you.